Welcome, folks. The ratio analysis, it's a final outcome of the financial statement. If you already know how to prepare the financial statement, it's called SOFP, Statement of Financial Position, and SOCI, Statement of Comprehensive Income. By using this financial statement, we can make some kind of ratios to interpret the financial performance and to interpret the financial position. So, but by looking at the financial statement itself, we can get some idea about the business organization. We can say the rough idea by looking at the numbers, but basically, in order to get a proper idea, we have to compare it with the other some other line. So this mainly that is we are doing with the ratio analysis here. So we are going to do the interpretation part of the financial statement, which is very important and very crucial, because this is the proper understanding, because the preparation part is like a technical side of the business organization, like how to prepare the income statement, how to prepare the SOFP, technical, but you must be able to interpret those financial position and the financial performance by using proper ratio analysis. It's a highly mathematical thing. There is mathematical models like a ratio are there, but normally in examination you are getting a formula sheet. Therefore, no need to memorize any ratio here, because you are getting a formula sheet and the exam paper. So understand how to calculate, analyze accounting ratios, gross profit margin, operating profit margin, markup, return on capital employed, current ratio, acid test ratio. These are the lessons, the ratios that we are going to do. And also you're going to understand the concept of importance of liquidity, and you're going to understand how to make comparisons with the previous years and know with other business organization using ratios. You can see normally the statement of financial position can show the financial position of a business, and the statement of comprehensive income can show how well it has performed, the performance of the business. For example, the statement of comprehensive income show how much profit a business has made, and the statement of financial position show whether the business can pay its bills. Look at the example below. You can see this organization is Orient Plus PLC. Orient Plus is a specialist producer of high quality children's clothes. At the end of 2015, the business started struggling the following arrival of the new competitor. Business has struggled following the arrival of a new competitor. The impact was severe, and at the end of the 2016, Orient Plus announced that 12 of its 32 designs and production staff would be made redundant. So they had to make a crucial decision to shut down some of the operations. They had to announce that 12 out of their 32 design, production, and staff would be made redundant. So by looking at the financial statement, they're asking what evidence is there to support the view that Orient Plus is struggling. And also, second question asking how might the redundancies improve the financial performance at Orient Plus. It happened during the 2015. You can see the revenue gone down. You can see here the revenue value is 1.2 million figure is there, and the US dollar, and then this year is 890,000. So it's gone down by about 400,000 US dollar. And cost of sale gone down. That is not that significant, because anyway the revenue gone down means cost of sale also going down. And gross of it, you can see gross of it gone down 897,000 to 588,000. So almost about 300,000. There's a difference. Administration expenses gone down. I think cost controlling. Other operating expenses gone down. Operating profit actually significantly gone down, 273,000 to 57,000. Right, more than 200,000 US dollars decrease. Finance costs increased during that time. Profit for the year, huge difference is a profit situation to loss situation. Right now it's a minus figure, and this year the taxation is not there because of the losses, and profit for the year after taxation is 158,000 to minus 2,400. Like that, you see how the business organizations actually they perform badly during that year. And also you can see the extract of the SOFP down, the SOFP of the Orient Finance PLC, statement of financial position at the end of 31st August 2016. So they have given the figures: inventory level increase, trade receivables gone down, cash position gone down heavily, 128,000 to 12,000, and the total assets actually decreased 685,000 to 554,000. And also current liabilities actually gone up 446,000 to 539,700. So like that, this is the situation. Now looking at these facts and figures, we can make a conclusion that the business actually performing badly. The financial performance is bad, and as well as the current asset situation, the asset liquidity situation of the business actually that's also gone down. Especially, you can see the decrease of the cash position. It's a good evidence, and also increase in the current liability. The liquid level also gone down. Financial performance gone down. So financial performance is really anyway is bad. And also they have made some kind of a redundancies during the year. You can see that they have evidence because that's the administration cost goes down. That's a good evidence. The salaries might be deducted as a result of that. So redundancy is also affecting to that. So we'll see what's the marking scheme say here. Normally, question number 1. What evidence is there to support the view that Orient Plus is starting to struggle? Right, Ranusha, can you read that first question?
Both the statement of comprehensive income and the extracts of the statement from the statement of financial position show that Orient Plus was hit by the arrival of a new competitor. The revenue of the business fell from US dollars 1.23 million to 890,600 US dollars. This is a fall of about 28%. The profit for the year made by the business also went down. In 2015, Orient Plus made a profit of 158,600 US dollars. However, in 2016, this turned into a loss of 22,400 US dollars. This is only a small loss, but it is a big drop from the previous year. The extract from the statement of financial position showed that the working capital and current assets has fallen sharply from 239,300 US dollars to $14,300. This may well mean that the business has difficulties in paying day-to-day bills.
Okay, thank you. So mainly by looking at the evidence, you have to mention if this kind of a question is there. For example, what evidence is there to support to the view? So you have to always give this kind of a question application. So by looking at the financial statements, you can see they're hit by the arrival of new competitor. Their revenue fell from 1.2 million to 890,000, and you can calculate the percentage wise the difference of the value, no, the final minus initial divided by initial into 100, that 28% gone down. The revenue gone down by 28%, and also profit gone down. The percentage, that is the net profit, 2015 158,000, and then during 2016 is a loss of 2,400. So this is only a small loss, but it's a big drop from the previous year. That's why. And also SOFP, the financial position level, you can see by looking at the net current assets figure, that is the current assets minus current liability figure. Actually, that's fallen sharply from 239,000 to 14,300, like that. Which they have been facing some difficulties in paying day-to-day bills as a result of the liquidity problem. Okay, the question number 2, they're asking how might the redundancies improve the financial performance at Orient Plus? Right, Saranya, can you read that question number 2?
Making staff at Orient Plus redundant could improve the financial performance of the business. This is because if people are made redundant, the wage bill will be reduced. With lower wages, costs will fall and the company may return to profit again. However, making staff redundant may result in production difficulties.
Yes, thank you. So mainly by looking at the financial statement, income, especially income statement, you can see there's a reduction of the administration expenses, as I showed you previously. Because the people's made redundant mean they are send them home. That is, they fire or sometimes they ask by the organization to leave because there is not enough work to do, and then as a result, what happens? Their wage will be reduced. With lower wages, costs will fall, and the company may return to profit again. But the problem here, you can reduce the staff, but the problem with the quality coming again, the making staff redundant may result in production difficulties. production difficulty. These are the main problems, reasons actually regarding this situation. Right now, but normally organization, like I already, I think I submitted you the all the handout today. So you can see in the handout, I have given some kind of past paper questions, everything, the summary of the lesson, everything. So here you can see in the beginning, all our financial statements, you can see ratio analysis. The definition you can write down there if you have the financial statement. You can see what is ratio analysis. You can see it's a mathematical approach to interpret the financial statements. It's a mathematical approach to interpret the financial statements. So in this business, normally it's a mathematical approach. It's a mathematical approach to interpret the financial statement, especially their performance and the liquidity. Right. We are learning different types of ratios here. Profitability ratio, and profitability ratio we are doing gross profit margin, net profit margin, and under liquidity ratios we are talking about the asset current test ratio, asset test ratio, right? And then under shareholder ratios we are talking ROCE. There is no gearing ratios we are doing. A shareholders ratio we talk about the return on capital employed, that how much return you are taking over the capital employed from the business. So altogether you can see how many ratios we are doing. So this is the formula sheet for the IGCSE. In our business paper. Usually they are giving these formula sheets like this in the beginning. I'll show you one of the IGCSE paper. So normally this is one of the past paper question came in the this is June 2020 paper. So here you can see this paper is investigating large business paper. You can see here after first the cover page, the second page is the formula sheet. Second page is the formula sheet. In formula sheet, you are getting all the financial ratios formula that you need to memorize. No need to memorize this thing. So therefore, in our today's lesson, we are going to cover these things: gross profit margin, how to calculate the gross profit, is revenue minus cost of sale, and gross profit margin equal gross profit over revenue into 100, gross profit over revenue into 100, and operating profit margin. How to calculate the operating profit? Operating profit equal gross profit minus other operating expenses. So operating profit margin equal operating profit over revenue into 100. And then markup percentage, markup equal profit per item divided by cost per item into 100. Profit per item divided by cost per item into 100. And ROCE, return on capital employed, operating profit over capital employed into 100. And current ratios, current assets over current liability, and asset test ratio, current assets minus inventory over current liabilities. These are the all formulas that you had to learn in the financial ratio lesson. So everything is there in the past papers. Like every paper, you have the second paper is a formula sheet, right? So in the formula sheet, that's why you have to everything is here. The financial statement ratios are everything there, but other, some for example, break-even formula is not there. Break-even formula you have to memorize. So like that, there are so example, how to calculate percentage changes, how to calculate the market share, how to calculate the for example like a small mathematical calculation. Those formulas are not we are giving here. So you have to give in only these formulas only we are giving. So you have to don't need to memorize these things. If you are doing accounting, already you are very familiar with these formulas, because in accounting also you have another separate chapter called accounting ratios. So here, same thing you can apply here as well, right? Okay, we go back to the lesson. We talk about this Orient Finance PLC. That Orient PLC actually have a deep financial problem because of the entering of the new competitor into the market. Their revenue gone down as a result of that. All the performance gone down. It's make a profit-making business convert to loss-making business right now. All right, now I'm going to looking at the ratio analysis. The definition of ratio analysis, you can write down this one. As I told you in the beginning, it's a mathematical approach. It's a mathematical approach to investigating accounts by comparing two related figures. Please write down that definition in the handout. So it's a mathematical approach to investigating accounts by comparing two related figures, which is a mathematical approach. To what? To investigate what? To investigate accounts. Accounts mean financial statement, income statement, and balance sheet, SOFP. By comparing two related figures. Comparing two related figures mean it can be the sales and gross profit, sales and operating profit, current assets and current liability, like that, two related figures you can compare. So it is possible to look at the statement of financial position and statement of comprehensive income and draw some conclusions about the financial position of a business. However, a more precise way to use is ratio analysis. As I told you, by looking at the financial statement, we can find out the business is doing well or not. But it is more precise. It's a very important to do a ratio analysis thing, because then only we can get some kind of example by looking at the financial ratio of the two companies, Apple and the Microsoft. We can't actually judge like by looking at the financial figures. We can say, okay, Apple is making this much of profit. Google is making this much of profit, but comparing the ratios only, we can get a very good idea. Okay, the gross profit margin is this much, the operating profit margin is this much, their ROCE is this much, their liquidity is this much. Like that, by looking at this financial ratio only, we can make like a comparisons. So by looking at the numbers, we can't actually make a good like a it doesn't make any sense by looking at the comparing numbers. Sometimes the numbers can be big or numbers can be small, but percentage wise, sometimes small business actually performing very efficiently than the large businesses. Therefore, ratio analysis is really important to looking in that extent, involve taking the figures from the accounts and calculating the financial ratios. And there are different types of financial ratios. The two groups that will be examined in this chapter are below: profitability ratio and the liquidity ratio. In the profitability ratio, the measures the performance of the business and focus on the profit, revenue, and the amount invested in the business. And liquidity ratio, we are talking about the measure how easily a business can pay short-term debts, short-term loans such as wages or supplies. So these two things we are going to discuss: profitability ratio and the liquidity ratio. You can see here in the financial statements, in the formula sheet. So I have given all the related formulas. You can see the profitability ratios, which the gross profit margin and operating profit margin and markup. And liquidity ratios, you should know the current ratio and the interest ratio, two things, right? So these ratios will do one by one. Right now you can see gross profit margin. So I'm going to teach you the first one now, the gross profit margin, how to calculate the gross profit and the gross profit margin. So gross profit margin definition, we can see it's a gross profit margin, or sometimes we call markup. It's a gross profit expressed as a percentage of a turnover. Turnover means sales revenue. Another name for sales is turnover. So we express the gross profit as a percentage of the revenue, as a percentage of the turnover. So that's why we can relate two figures and we can find out, okay, for my sales figure, I'm making my gross profit margin is 20%, which means the business organization can get some idea from every 100 rupees, $100, they have 20% or $20 profit margin. It's like that. So gross profit margin shows the gross profit made on the business on revenue. It is calculated using the following formula: gross profit margin equal gross profit over revenue into 100. Gross profit over revenue into 100. Right? So look at this example here. Eco Homes 2016, the gross profit there is 11 million US dollar. 11 million US dollar they have given, and the turnover was 23,500,000 US dollars. So now we can easily take the fraction of this thing, gross profit margin, 11 million over 23.5. So then 11 million divided by 23,500,000 into 100. Always you have to multiply by 100 because it's a percentage. 100, right? So you are using, because you are allowed to use the calculators in examination, so therefore you can easily get the value. Sometimes the answer they're asking for 1 decimal points. So sometimes they're asking for 2 decimal points. Right? So, and percentage sign must be there, or otherwise you can write the percent or percentage sign you can put. For this case, 11 million divided by 23.5 into 100 is 46.8%. 46.8%. In 2015, their gross profit margin is 8.3 million divided by 18.4 million into 100. So that is 45.1%. 45.1. By looking at the figures now, we can find out the gross profit value, whatever. 45.1 to 46.8 increase, right? So now we are going to find out, to increase the gross profit margin, the revenue must be increased. Here what happened? The revenue increase. it increased to 18 million to 23 million, right? Or cost of sale can reduce. Otherwise, you can reduce the cost of sale. If you reduce the cost of sale, your gross profit can increase, right? This case, both happen. Gross profit also increased 8 million to 11 million. Revenue also increased to 18 million to 23 million. So keep in mind always the denominator and the numerator. You can, by manipulating these two, we can actually make this thing change. Okay, the gross profit margin 2016 was 46.8%. This means that the gross profit was 46.8% on the sales of $1. Higher gross profit margins are better than the lower ones. So that's a normal theory. Higher percentage is better than the lower percentages. But some industry standards are there. For example, if you talk about the normally agriculture business, agriculture, fruits and vegetables and corn farms and paddy fields, so these farmers, they are not keeping that much profit margin. They're having a small profit margin because the gross profit margin actually, it depends on the business. Example, if you talk about the jewelry, the diamond, right? Like the different industry, diamond jewelry, like that industry. So that gross profit margin is high, right? Real estate business gross profit margin is high. Real apartment business, for example, if you buy some house apartment, the gross profit margin is sometimes 400%, right? But if we talk about the agriculture business, sometimes gross profit margin is 10%. So you can see that depends on the business gross profit level, the gross profit percentages vary, right? So basically agricultural businesses, right? Farming, fishing, agriculture, quarrying, mining, small gross profit margin we can see. And industrial business, assembling and converting, finishing goods, like vehicles, motor vehicles, furniture, construction of building, they have a huge gross profit margin they are keeping. Service sector, huge gross profit margin they are keeping, because service sector businesses, the cost of sale is very low, right? For example, if you talk about the banking services, insurance, communication, advertising, the cost of sale is very low because they are not dealing with the inventory, right? But they're charging huge amount for their service charges. Their gross profit margin is very high. So like that, so that depend on the business is always the gross profit margin is vary. So a lot of people, business organization, gross profit margin for eco homes has improved slightly over the 2 years. By looking at the statement, you can see gross profit revenue increase and cost of sale increase. Gross profit also increase. So the gross profit margin would be increased. Right. So this one actually I have given in my handout also. So you can go to the financial statement, tute number 33. There you can find out the first formulas for gross profit margin. How can company improve the performance? Gross profit margin can increase by increasing sale or decreasing cost of goods sold. By looking at the ratio analysis, like you can see I gave the advantages and disadvantages as well. The general advantages of ratio analysis and the general disadvantage of ratio analysis. So always ratio analysis, we can find out our profitability of the business organization. It is not enough. We can formulate some strategies to make it increase. And also we can find out the solvency of the business organization. Right, the business actually is at bankrupt or not. Solvency means how much enough availability of cash for the business organization to pay their debts, right? So it is a business that allow them to make strategies to prevent failure in advance, and also you can compare performance to previous years or even competitors. However, ratio analysis has these disadvantages. Ratios are based on past results and may not accurate. Sometimes a lot of people criticizing the ratio analysis is always ratio analysis expired figures, past figures. So it's like a ratio analysis. Sometimes some people are telling it's like you are driving a vehicle by looking at the rear mirror, right? So you can't drive a vehicle by looking at your rear mirror. So you're looking at the front, what's coming to your face, but you already passed. So like that. It's like a business also, something like that, like you're driving a vehicle. So always predictions are more important. That's why some accountants, some professors, they are telling that, okay, in the business organization, more than the past information, future is really important. Futuristic, the predictions of future prospects are important. Sometimes even some in share market, sometimes some loss-making businesses, there's a huge demand coming these days. Why? Because their financial is not that much good. They are sometimes last years they loss making. Some hotel industries they loss making, but now the hotels are actually going up. Share prices are going up. Why? Because people are thinking their future will be good. Now COVID actually control, and then the country gonna open, and then tourism will be increased. Then tourism comes up, the hotel will get more demand, more money will come. So like that, people always like to think about the future, like predicting future. For example, like some agriculture companies for like last couple of years, the government actually that have some bans on importing chemical fertilizer and pesticides. But now government has actually some reduced some regulations, and then they allow fertilizer companies to bring import all the chemical fertilizer little by little. So as a result, now share prices of all that company agriculture uh, companies, share prices gone up, but their financials are not that much good, impressive. Financials are performance, gross profit margins are bad. That's why. So always investors always they like looking at the future, not the past. By looking at the past records, you can't make a good decision because it's always depending on the future. So always, if you're an investor who looking to invest in share market, you have to think about the futuristic thing, what's going on, what's happening in the future. So the government policy changing, so the budget coming up, what are the changes can be happen. Like that, you can see these days, there's a increase of the gas prices, there's increase of the fuel, and also there's increase of the cement prices. Now all the gas companies like Laf Gas Company and Tokyo Cement Company, all their share prices gone up. Why? The people are thinking, okay, now their prices increases, they can make more profit, like that. So always, as I mentioned, the first disadvantage of ratio is ratio sometimes past figure, right? By looking at the past figures, you can't make accurate decisions because you don't know how the business will perform in the future. Sometimes you have the record is very bad in the past, but future will be brilliant with the government external factors, right? Another thing, to work out solvency, readies business allow them to make strategies to prevent failure in advance. From by using ratio analysis, we can find out the solvency problems, liquidity issues. If the business have a certain liquidity issues, not having enough money to pay their bills, to pay their debts, short-term debts, then that's called the solvency level. How you actually business have the reserves and everything to meet these liabilities. So that's advantage. However, disadvantage, you can see accounting figures will be affected by inflation and maybe misleading sometimes. The data is not real and they're adjusted for inflation. You can see sometimes the cash value with you is always sometimes not a real value because it's inflated sometimes from the inflation. High inflation level is there. Sometimes the revenue will the increase, you can see 8 billion to 11 billion, but actually the revenue has increased not because of the actually quantity wise they're not increased, but the value wise they increase the selling price because the government increased the prices, the inflation. As a result of that, only the sales value increase. There's no volume wise there's increment, only value wise only they have increased the sales. Even cost of sales also like that. The purchase items, everything can be goes up every year like that because of the inflation will be affecting. That's why sometimes accounting figures are misleading. We can see our revenue goes up by 20%, but actually it's not 20% revenue goes up. It's actually inflation. It's actually inflation. So like that, that's another problem with the ratio analysis. With the inflation part, we have to adjust. Normally there are in advanced ratio analysis, we are doing inflation adjustment, but here in the basic ratio analysis, we are not going to adjust for inflation. Therefore, some academic, some professors, they believe that normally the ratio analysis is actually sometimes useless because of the inflation thing. And the third advantage, you can compare performance with previous years or even with their competitors. Ratio analysis is sometimes a comparison tool. You can compare your performance with other companies. If you are a group of companies, you can compare the different company, different associates and their group of company performance, or with a similar company. If you are a hotel, if you are owner of the hotel, you can compare your hotel business performance with another business. If you are a person who owns a cafe, a restaurant, you can compare your performance with another similar restaurant, like that. So it's very easy for comparison purpose. Like you can find out whether you're successful or not. However, another disadvantage of ratio is the different companies use different accounting methods. Right? The people who do accounting, they might know, for example, stock calculations, stock valuation, depreciation methods. There are certain depreciation methods. Some people are using straight line method of depreciation. Some companies using reducing balance method of depreciation, right? And also sometimes stock valuation methods also different. Some people, some companies are using first in first out method. Some companies using last in first out method or weighted average method, like sometimes. So stock valuation techniques are different sometimes. Accounting, depreciation policies are different, right? Different percentage for depreciation sometimes. One company depreciate their motor vehicle by 25%. Another company depreciate their motor vehicle by 20%. So like that, there are certain changes in accounting policies and methods. The company to company, the methods of accounting, I mean, not the format, I mean, the policy wise, there are certain techniques different. There's not one platform. As a result, the results may differ and not accurate, and they may be misleading. This makes comparisons difficult. Because in one company, they use a different method of stock valuation, therefore their gross profit is high. But other company, they use another different method of stock valuation, therefore their gross profit is low. Therefore, even here we are saying it's easy to compare, can compare the performance, but however, because of different accounting techniques, different accounting method, the comparison become much harder. So I think the people who know accounting, they know what is the accounting different, the techniques like straight line, reducing balance method, you know the difference of these things. That those are the main, like if generally, if the question asks, what is generally, what is imports of ratio analysis, or for a 12-mark question, evaluate the imports of ratio analysis for some business, then you must be able to tell these points with the application. Okay. Now I'm going to introduce you the gross profit margin. You can see here, first I'm starting with the gross profit margin. Look at this question, financial information accounts of the Delmage PLC. So I have given here 2008 and 2009 figures, turnover, cost of sales, gross profit. So everything I have given here. So if you want to calculate the gross profit for 2008, so what I have to do, 11,000 divided by 23,500 into 100. So 11,000 divided by 23,500 into 100. So here I can show you this figure. This is 2008 GP. You find out that 11,000 divided by 23,500, right, into 100. 200. So if you use this figure, then if you use a calculator, you can find out the answer. Always, if the question asks, always give the value for 2 decimal points. That is okay. 11,000 divided by 23,500 into 100 means you can get the answer 46.81. So I'm rounding out to 2 decimal points. So this is the answer, 46.81%. Right? In 2009. That is same, we can find out the gross profit margin for 2009. The figures for 2009. 2009, their gross profit is 8,300 and turnover is 18,400. The gross profit is 8,300 divided by 18,400. That multiplied by 100. So the answer coming here, 8,300 divided by 18,400 multiplied by 100. That answer is 45.11. So clearly you can see from 2008 to 2009 the gross profit margin gone down. Like that you can. This is a small calculation. There are some certain calculations are there like that. So this is the question. So calculate the gross profit margin for 2008 and 2009. So you can do that calculation here. That is gross profit formula. You can write the normally in examination you are getting the like a questions like this. So I gave a 2021 June paper here. So asking next, continually monitor progress and then can measure the success of the business. It's aimed to do this through improving the manufacturing techniques and cutting cost while still maintain the quality of the goods produced. So they show the selected financial information for the next in 2019. Revenue £1,000,000, they're 4,221. Operating profit 590. So they are given everything. They're asking here not the gross profit margin, they're asking operating profit margin for next. You are advised to show your working. Right? So calculate to the 2 decimal places. Look at this answer. They're giving the space also. Calculate to 2 decimal places the operating profit margin for next in 2019. So you're advised to show your working. So they're giving a box here, and in the answer they are giving a percentage sign. So here you have to just write the answer in the line, because percentage sign already they are giving, right? In questions normally their percentage signs normally they are giving, right, in answer box. But in some questions, for example in school paper, sometimes if you're not given the percentage sign, please put the percentage sign, right, in your answers. Right? In this case it's an easy question, because they are not asking the gross profit. Is operating profit margin. Operating profit margin equal, what's the formula? Operating profit over revenue into 100. So it's 590, right, divided by 4,221 into 100. So we can see the value 13.98. 13.9. The answer coming 13.97777. So we can round off to 2 decimal points. It's 13.98%. So to write down the answer here, 13.98. 2 marks for that. So maximum calculation question like this, you are awarding a 2 marks. 2 mark calculation questions only we are awarding, right? So in this case now, then we go back to the textbook. We can see this kind of questions only can come gross profit margin, and then the operating profit margin. Just now I show you how to calculate the operating profit margin with the past paper question. Operating profit margin definition is the operating profit expressed as a percentage of turnover. Operating profit margin is an operating profit expressed as a percentage of turnover. Even gross profit also we define like that. Gross profit expressed as a percentage of the turnover. So operating profit margin helps to measure how well a business controls its expenses and cost of sales. So really important. Operating profit margin, what they do, operating profit margin helps to measure how well a business controls their expenses and cost of sale. Because in the gross profit, we have find out only how the business control their cost of sale, but operating profit margin means gross profit minus all the expenses. But looking at the operating profit margin, we can find out how well the business can control their expenses and the cost of sale, especially expenses. If the difference between the gross profit margin and the operating profit margin is small, this suggests that the expenses are low. Okay, this suggests that the expenses are low, because if you have a high profit margin, which means you have a low cost percentage, right? And on the other way around, for example, if you have a low profit margin, means that means you have a high expenses. For example, let's say now 2016, the eco homes, they have 46% of gross profit, but 2015 their net profit margin is 17.4%. That means you can see the gross profit margin and net profit margin. The difference between that is the expenses. So same figure, you can use that thing. So operating profit margin, operating profit over revenue into 100. Operating profit over revenue into 100. This is the formula for operating profit margin. So today we talk about mainly the gross profit margin, operating profit margin, and I told you main advantage and disadvantage of the ratio analysis. And we talk about, I introduced mainly the profitability ratio and liquidity ratio, and I define what is ratio analysis also. So this is an interpretation of the accounting financial statement. So interpretation is really important, because this is really helpful for decision making. So if you are a businessman, or if you are a student, if you are a future businessman, or whatever, the person who is looking at the financial matters of the business organization must have a clear and thorough understanding of what's going on in the business. Therefore, ratio analysis is really important. By looking at the number itself, you can't make a decision. You have to take about the percentage value for the comparison purpose and for decision making purposes, right? So in my next lesson, next session, I'm going to discuss about the liquidity ratios, then with the more examples questions, how we calculate the liquidity ratios like acid test ratio and current ratio we're going to calculate in my next session.